Now let's have a look now specifically into the company. So the company called CVS Health, and when it first established, I think it's something in 1963 or something like that, or 90 in those years. And when it was established, the goal wasn't to become a pharmacy. It was completely different type of product, and nothing related to medical or whatever. So mostly related to health, but not to this specific case. Now, at the moment, they have a lot of different kind of streams of their income. And the major four I listed here, but in reality, they sell their products by different brands. It's not only CVS Pharmacy. They have also different brands, because when they expand, they buy other companies, the whole company, and they keep the brand of that company. So they're still selling drugs and selling their products through the company by their own name. So that's why when you look at the specifically there, like in details, you will see that they kind of have different brands as well. Now, but major four segments in their business is, first, it's pharmacy. So they have more than 960 stores located in 49 states, also in Colombia, Puerto Rico. So, and the interesting fact that 76% of US population now lives within 5 miles of CVS pharmacy. So it's, I'd say it's quite a big achievement, you know. So it's practically 3/4 of the population can get access to this pharmacy within the next 5 minutes if they drive there. Okay. Another business which they run, it's Minute Clinic, and it's the largest walk-in medical clinic in the United States with over 1,100 locations in 33 states. So, and again, more than 50% of US population now lives within 10 miles of Minute Clinic. Usually they open these clinics within the pharmacy. So you probably will see if there's a big building, it's not only pharmacy itself, it's probably Minute Clinic would be there as well. So they like assist with your small issues which you can have, which doesn't require hospitalization, and maybe kind of ambulatory services where you come put a bandage or maybe get some injections or stuff like that, you know. So they provide it here. Another one is business is CVS Caremark. This type of line of business provides comprehensive prescription benefit management services, now including mail order pharmacy services, specialty pharmacy, infusion services, plan design and administration. So it's client processing as well. So they're doing, it's like they're subcontractors here for other different organizations. So that could be insurance company, it could be military services, government departments, etc., where they deliver certain products when they inject those whatever medicine, etc., etc., etc. So it's different type of area. And then they also, it could be as a CVS pharmacy, but I'd say it's kind of a bit different. They call it CVS specialty. It provides specialty pharmacy services, so it's a bit different. You know, when you walk into service providers, you probably get only drugs there, but if you need some kind of maybe, I don't know, extra complicated medical service, etc., it might be here, okay, in this type of services. Okay, that's about in general about the business. So by looking at this, I can see that the business is quite huge, and it's grew quite a lot within the last 20 years. And it gives me certain reassurance if I decide to invest in this particular business. It gives me certain reassurance that, okay, great. Like, I mean, I'm happy with the quality of that particular business. Now, if you look at industry, and that's what we looked last time in January. So we analyzed this company, Walgreens, WBA, and now we're analyzing CVS. So you can see that here at least represented, they look like similar size. I'd say CVS a bit bigger than WBA. And look at what value line tells. CVS, they have safety rank 1, whereas Walgreens has 2. So it means that CVS is more secure company, but also it has timeliness rank 1. Whereas Walgreens now, they have timeliness rank tree. So it tells us that this particular company has a higher potential for growth within the next 12 months. That's an opinion of value line again. So take care about their opinion. But despite that, now we can see that the whole industry, like that's why we analyzed WBA last January and CVS now, because when Donald Trump, when the election was in process in the United States, and after that, a lot of pharmaceutical services, they were kind of challenged in the sense that they didn't know, investors didn't know what is going to happen, because both both candidates to presidency, they were telling that they're going to look at pharmaceutical industry and trying to improve accessible, like make it accessible for a lot of people, and usually it happens by reducing prices or putting some extra charges for this type of companies. So that's why the price, it didn't give reinsurance to investors, and insurance started selling the company off. So as a result, the share price went down quite a lot. Okay, so that's how it works. Now let's have a look at the value line. By the way, did you look already at value line? So can you put plus if you did, and minus if you didn't? Okay, great. All right, let's have a look. So first of all, we can see the price was $80 before. Now it's 76, so it's a bit $4 less, 5%. Now here we can see it's still timeliness. Timeliness is 3. Now I showed you the reviewed number. It was when it was, I think it was in March, the report. So within the last 3 weeks, they improved timeliness rank. Safety is 1, still pretty good. Beta is 85, so it's low volatility than market in general. So now value line predicts that the share price for this particular company within the next 3 to 5 years might reach $130, $155 level. So it's practically double from the current prices. If it goes to 150, now 76, it's doubling. So it represents about 20% of growth annually, which is pretty fantastic, right? Now, what we're going to do, now we are going to compare our results with value line results, okay, by like checking it fundamentally, and then we'll see what is going to happen. Now, I looked from Guru Focus from earlier stage, but value line doesn't provide the whole report. But what it's interesting, if you see what's happening here, 53, 60, 70, the slide here, the drop, actually the interesting thing, just remember that, because after that we're going to look at technical analysis and we'll see how it's affected the price. But see, in 2009, the revenue, the sales dropped to what? About 20 cents. So it's 0.2%, like, okay, maybe 0.3% in general, the drop in the sales level. Although the earnings were still going up, so 263, 269. So earnings weren't affected per share. Now, after that, each year, company was growing on sales. So you can see 100, 107, 122, 139, 167, right, 180, and they were planning 194, and etc., etc., etc. So it gives us certain reinsurance, right? So let's have a look. Earnings for us more important than sales. And we can see 190, 240, 260, 269, 280, 340, 450, 516, 584. And here we can see 284 to 85. It's still growth, but only 1 cent growth, not like before. Okay, and one of the reasons I believe for the price move down from 113 and now 76, I believe is just that they started showing that the growth stopped. So sometimes that's enough. When the growth stops, investors start pulling out because they're afraid that it might not continue again and company might slide down completely, and that's why they're doing it. Okay, so it could be one of the reasons why share price has dropped for this particular company. Now, by looking at further projections, we can see that the company within next year they're planning to do 635 and then 860. So they still have a positive projection about their growth, which is good in our case. Now, another thing which is important for us is dividends. So we can see that dividends, they grow in every year. They increase dividends for the last, I think I've read somewhere for the last 20 years. They didn't have even one year of not paying dividends. And it's quite significant in a sense. Just remember that you're paying $2, okay, $2 a share for the dividend, and it's important because I'll show you something. Then we are going to look at technical analysis, and you will calculate the power of long-term investing, okay, in this particular case, and the power of dividends as well. Now, remember, just $2 this year, they're going to pay 50 cents every quarter. Now, another thing that I wanted to ask you, why do you think, look, their earnings $5.80, but their cash flow is higher? It's like 50% higher, 580 and 850. So why? Can you explain me why? I'll ask you. You know, I can explain, but can you? Why is the situation when you can see that cash flow in a company is higher than its income? No, not interest. If it was income from elsewhere, it has to be shown as an income. Margin, what do you mean by margin? Okay, so I'll explain you guys. Now, imagine the situation like that. Just, I'll give you abstract example, and then it would be easier to understand. Imagine that you've got a building, right? And you produced $1 million or whatever, 1 million of something of profit. And then this building, like the initial cost of that building was, for example, I don't know, like $100 million or $200 million, whatever. And then you decided to depreciate this building. So what you do, you have $1 million profit, but then you say, wait a second, I'm going to depreciate my building for $500,000. You have money. It's not like you're spending this money, right? So, but you put in $500,000 in your expense column. And what you can see when investors who invest in your business, they see, oh, you have only $500,000 profit, net profit, but you have $1 million of cash inflow because you've got 1 million, but you show on the net profit of $500,000. Similar situation can happen with goodwill. Imagine if I acquire different company, I purchase this company, and now on my balance I have not asset which is tangible like a building, but I have intangible asset which is goodwill. And we already looked at this, what goodwill is. And it doesn't give you any income, or it doesn't give you any good or bad, this goodwill, when it's on balance sheet. So, and some companies, what they do in order to reduce their tax, and they just write it off. So, and in this particular case, we can see that something, right, was written off for nearly $3 here. Okay, and the cash in this case, it's always higher, which is pretty good. And the reason why we need to look at cash, I'll explain you in a second after we go to the debt level. Okay, all right, so that's pretty good one. Now, another thing which is pretty confusing about CVS Health is their book value. So the book value is $37, which is not bad. I mean, compared with the price of $76. So it's just about 2 times. But if you go to, let's say, Guru Focus or Nasdaq or any other company, and you try to look tangible book value, when you deduct all these intangibles, goodwill, patents, and etc., 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 you will see that it's quite different here. So you have to pay attention to that. So this book value and value line doesn't represent a real situation which happens on a balance sheet. So if the company, for whatever reason, goes to bankruptcy, you probably won't be able to get this $37. Okay, that's the risk. But in our case, we have to pay attention more to book value when we invest in a company which has troubles. Now, this particular company doesn't have like a lot of issues, and probably it's not going to get bankrupt within the next 10 years or so. You know, at least I don't believe in this, and so that's why I won't like look at book value quite a lot in this particular sense. Okay, but you have to pay attention to that. Okay, another thing which is we're going to look at this in details further, but still look at PE ratio. Okay, price earnings ratio, and we can see that in certain years like it was 12 and sometimes it was 19. Okay, so we can see that in some cases investors were happy to pay only 12 times of their earnings, but sometimes they were paying nearly 20 times of their earnings, and it's probably based on their and it changes every year. So even within 1 year, if you compare, because the price can go 64 and 98, and that's the average. Okay, so when you go 64 and divide by the earnings $4, okay, you will see 1 P ratio here. So it probably would be 15, right? And then we go to maximum 98 and 4.5, it would be nearly 20 with something. And then when you get average, it becomes like 17. Okay, so that's how they calculate it. So, but yeah, again, pay attention to that, because we're going to look at make our own calculation. But within last 5 years, we can see 1, 2, 3, 4, 5. The lowest was 13.2, and the highest was 19.7. Okay, so that's a good thing about it. Now, what else? Margin. When I'm looking at this particular company, and when I'm hearing that Donald Trump will implement certain actions that trying to reduce the profitability, like margin for these particular companies, when I see at margin, it's 18% gross margin. It's not that high. It's one thing. When I look at net profit margin, it's 3.5. It's even smaller. So I don't see that government will try to reduce it, because if they show them this number, it's not like in Guild. When you look at Guild net profit margin, I think it's 50%. That's where they can attack. But in this particular company, they cannot attack. So they work with a quite low net profit margins. But still, every time when it goes down, so for example, here it was 20% of margin, and now it's 18. What it means that if they sold products for $100,000, they had about $20,200 of gross profit, whereas now they have only 18. In order to get 20, now they have to sell not $100 of product, but for example 104. So their sales have to grow a bit higher in order to generate same type of level of income. Okay, that's why important for us to know that what's happening with margin. But they believe that they can increase the margin already within the next 2 years, okay, and increase it up again. So that's a good sign for us if they believe in that. Okay, and net profit margin will increase higher. Okay, so the next thing which is important for us is debt, and the debt is $27.5 billion. Okay, and their capitalization is $82 billion. Now the debt is quite high; it's more than 30%, definitely. So the question is for us: so what kind of questions we have to ask when we have a debt like that? So company, can it pay this debt? So is it going to create certain issues? We looked at Asana recently, right? And Asana has huge debt, and interest on that debt is killing the profit of this company. So company is in loss, right, because of that debt. Now let's have a look how much money company makes, and is it possible to pay this type of debt. And in this case, we just go here, net profit. So what we can see that last year, company generated 6.3 billion net profit. Okay, now the question for us, how many years is required in order to fully pay this debt? 4 to 5 years, correct. And now I'll tell you different thing. Now that's net profit, but look at cash flow. Cash flow is 50% higher. So if you take like 5.85 multiplied by 1.5, you probably get around this number, yeah, about $3 here. So actually the cash flow is higher. So the cash flow is about not 6 billion, it would be about $9 billion. That's their cash flow, because based on calculation here. So if their cash come in $9 billion, and they can use this cash, right? They can do something with this cash. In this case, how many years will be required in order to pay this debt? Only 3 years, right? So that's the thing. But then we have to deduct dividends, because they're also using cash to pay dividends. So in this case, yes, about maybe 3.5, 4 years, if they decide to pay this debt, that will be enough. So it's not that bad. I mean, majority of companies, they have long-term debt above 5 years, and 11 billion they have to pay after 5 years. So so it means that about what, 16 billion they have to pay within the next 5 years. Okay, majority of that. So it tells us that companies in pretty good shape and quite easily can handle this type of thing. Now, but still, a lot of people will ask, why would you borrow so much money? And if you look at the last several years, you will see that companies aggressively growing by buying new businesses. And the question is for you, okay, what are you going to do? Are you going to spend cash which you have by just closing the debt which you have, or by buying new business? That's the question which every CEO of the company has to ask himself and answer in front of investors. Now, what do you think? Is it better to pay the debt, or is it better to buy a new company or invest in a new company and buy a new network? So what do you think? How can you assess it? Yeah, Dory's good point. Yeah, absolutely. So the easiest way, yeah, absolutely, as long as it's sustainable. So if we buy a new business and this business generates zero income, it's not good. So that's why we look, okay, fine, how much money we're making by investing our capital? And that's where you see it, okay? Return on shares equity. So that's return on the equity of the shareholders. And then on the total capital, that's the total capital. So it means that whatever company has, when they invest, they generally get about 10% of return. So the question is now, is it okay to borrow money and pay 1% or 2% to the banks, and then using this money make 10%? So it's 8 to 9% of profit on that particular deal. So in this case, I would borrow as much as I can, right? So because that's definitely generating money. So if I can allocate this money in a proper way. So that's why I believe that this particular debt is not bad, as long as they keep investing in the same type of line. And we can see that probably their performance become even better. Look, if we look at 2007, their return on total capital was 7%. Then 8 and 9, and 9 like 10, 11. So and now it's around 10, 11%. So it means that they're much better in investing right now. So probably they have better buying power, and they can invest and buy businesses on cheaper scale. So which is pretty good. Now Dory has a very, very good point. As long as Amazon doesn't get aggressive in the pharmacy businesses. Now, I presume, like it's my opinion again, that Amazon, if they start opening this kind of businesses, majority of Amazon supply now is through online, like they deliver through postal services, normal postal services. You cannot deliver a lot of drugs through the postal services. You just can't, okay, just legally can't. So in this case, they will have to find somebody, some other organization which is licensed to deliver this drugs. And like we looked at CF, like that's the industry, that's CVS Caremark. They're providing this delivery stuff. Okay, so they're doing this. So I presume even if Amazon is selling, they will subcontract the delivery, and probably that would be CVS. Okay, for delivery. And again, I'm not sure if they can sell drugs without prescriptions. Probably it would be over-counter drugs like Panadol, paracetamol, bandages, and stuff like that. Okay, so kind of, because majority of drugs still will be sold through the pharmacist. Okay, you have to deliver the receipt. Yeah, probably, yeah. Everything you get at Kohl's, you will be seeing it in Amazon. That's true. That's true. Okay, that's here you can see the growth rate. Actually, let's have a look at the current assets and liabilities. What we can see that the cash growing up, it was 2.5 billion. Now it's 3.4 billion. General assets, current assets were 2.5 billion, 25 billion, nearly 26 billion. Now it's 31 billion dollars. Okay, their current liabilities grew up as well, but still they have quite positive here balance. So 31 billion in assets, current assets, and 26 billion in current liabilities. So they have about 5 billion dollars here in current assets, which is pretty healthy. Okay, for this, so company has money to to acquire another company if they want to go buy aggressively, or they can pay dividends, or they can pay debt. Okay, which is pretty good. Now that's where we can see the growth rate. We can see that company for the last 10 years pretty stable in growth, right? Around 12% in sales and 14% in earnings. And here, last 5 years, it's kind of slowed down. And they are planning to grow, but they are planning to grow in a smaller scale, only 8% in this. And I believe it's quite normal, because the bigger the company becomes, they're more difficult to grow, because I mean, it's like, I mean, if you open 10 stores, when your size is 10 stores, you kind of grow 100%. But if you have 100 stores and you open 10 stores, it's already 10%. But if you have 1,000 stores and you open 10 stores, it's only 1%. Okay, and I believe that it's more difficult to grow when you are bigger. Okay, and we can see that constant increase in dividends here. Okay, last year they were paying 45.5 cents, and now they're going to pay 50. So that's why the increase in dividends, which is pretty good for us. Okay, so that's about fundamentals in general. So how do you like this company, guys? Do you like that? Don't like the company? Yeah, pretty good, pretty stable company. Another thing which I wanted to point for you is look at this corner, right corner. Okay, and what we can see, company financial strength A++, stock price stability 95%, price growth persistent 80%, and what I really like is earnings predictability 100%. Because every time when we look at the future projections, we can say, oh yes, they project, but is it going to happen like that or not? And when we look at some companies, we can see it's only 10%, so it means that they are wrong in 9 times out of 10, right? Whereas this company, it looks like they're right 10 times out of 10, which gives us certain reinsurance when we look at their projections, what they're planning to do. Okay, so that's what I really like about the company, because when we invest money, it's much better to be calm and sleep well, right? And if company doesn't know what they're going to get in the future, it's kind of bad for us. All right, so what if we use TACN analytical tool table? What kind of results we're going to get? So we can see that it's 42 points by quality, so it's above 40, so which is pretty good. Okay, and we can see that it's only lost points where we can see it's lost point in debt. Okay, it's got 4 instead of 8, and because the level of debt is higher. But we looked at this that is manageable and company quite well can handle it. Then beta, I showed you in the very beginning that volatility is 85, and we're looking at companies which are volatile but not very volatile. So, and in this particular case, it's lost points here. Okay, and then it lost few points in growth trend, and the reason for that, the growth trends here we can see that it's below 15% of growth is first thing, and secondly that we can see that the sales are growing faster than earnings or the same, and we are trying to find companies which are growing in earnings faster than sales. But in general, still this company is quite strong fundamentally and very stable investment. So if you decided to invest like for long period of time for your children, that's probably would be one of the companies on the market. And we looked at several companies within the last 2-3 years like that, and one of them probably yes, Safety is one. Safety is one. Okay, let's have a look now at price calculations. By calculating this on, I always explain how I do it in order for you to understand. It is possible to look like that. First of all, we know that that's the highest prices within the last 5 years, 49, 72, 98, 113, 16, and then we have a lowest prices. So we can see that the company fluctuates between low and high here, 41 to 49. It's about 20%. Okay. If you look at Asana, you will see that Asana did probably like, if we don't take into consideration the last drop, which is nearly like killing this percentage, but within a month it might move 20% altogether. So it's, can you imagine? This volatility is much lower than general on the market. That's why its beta is so low. And here as well, it goes up to 50%, but not probably more. Okay, so when we calculate it, we look at this, that value line shows us that price union ratio for this particular company in average, like we saw it, but for us important to know not only average, but also how low within the year it was, like the minimum. And what we can do, we can actually take this $3.43 and then we take the lowest price and then divide lowest price by the income, and we'll get it here. So if we divide 41 by 343, how much we get? Just a second, just do it my calculations here. It's 11.9%, nearly 12. Okay, but then if we take $49, right, and divide by 3.43, we get, it's higher, like about maybe $14, 14%, 14, sorry, not percent, nothing. So, and that's kind of any time. So we can do this way, but the easier way to do it is just like calculate the averages. So we can see that average high was 88, and average low was 61, and average earnings was 459. And then after that, we can calculate the average low and average high for the last 5 years. Now, when we calculate it, so we need to divide 61 by 4.59, and we get 13.3. So it means that within the last 5 years, people, investors, when they lost confidence, they were paying in average 13.3 times higher than the earnings of this particular company. Okay, and maybe like, because it's average, it might be a bit lower. Like now we calculated 11.9, so sometimes it's higher, but in average we can see that's 13.3. And then we take the maximum prices and we divide by same average income, we get the 19.2. So, and we know that when people excited and they are positive, they're happy to pay 19 times higher than earnings of the company. Okay, now guys, put the pluses if you understand this part before I proceed. Okay, good. Now, so what we do, so if it was happening within the last 5 years, we can assume that it's going to happen in the future too. And the way we do it, so what value line and company itself projects that they're going to make $8.60 in the future. I show you where I got this number. So this is number, you see. Within the next 3 to 5 years, they are projecting that they're going to make $8.60 a share. So what we're going to do here, maximum PE ratio. So we assume, okay, if the PE ratio would be like that, and if the company achieve these results, the maximum price at this particular case, right, the price can go to 165. That's how we can calculate the highest price. So we can assume within the next 3 to 5 years, price someday can achieve 165. If the earnings will be higher, it can go higher. If the PE ratio will be higher, it can go higher. But based on our average in the last 5 years, within the last 5 years, we can assume that the price can go to 165. Then we need to calculate the lowest point. Okay, we know that our PE in the lower scale was 13. And we need to look, okay, what's the worst earnings we can have? And we can see that the last year earnings, actual earnings, $5.85. So we take into consideration, okay, what happens if the company doesn't grow? What happens if the company will stay on the same level? And we multiply these two numbers. So 13 times multiply by 584, and we get $77. So in this case, we can say, okay, fine, if the company is not growing and the PE will be 13.3, the price has to be $77. Now, can it be different? Yes, of course. When? If the company start making less money, right? So it can be different. Also, if the investors, they will feel more kind of pessimistic, right? And they might pay less for that. So in this case, the share price might go even lower than $77, right? And look, what happens now? What's the price? The current price is lower than our calculations. So at the moment, when we are looking at different companies, to find a company which is in this range above 77, it's quite difficult. Now we found the company which is actually lower than their lowest point, which is like based on that calculation. Now, when we calculated these two prices, we understand that about 30% of the time, share price might be closer to the highest point, 30% to the lowest point, and 30% about in the middle. So that's how we calculate these ranges. So 77, 106, then from 106 to 136, and then to 165. So, and that would be undervalued, below 106. Then it would be kind of normal value, I would say average, and then it's already closer to overvalued. So if we're probably holding the stock, it's time to get out. Now, who remembers what numbers Value Line had about their projections? Where did they see this company in price in 3 to 5 years? And now we're going to compare with ours. Yeah, 130 to 150. They had 130. So it's very similar to what we have now. Okay, and it's actually pretty good. So we don't look at their calculation first. We do our calculation, and then we compare with other analytics. And if they have similar type of results, it kind of gives us certain reassurance. Okay. Now, in this case, we have a potential for this stock go up $88. And based on our calculation, we're already negative in risks. So we already have no risk, it's negative. Okay. In reality, of course, there is always risk. The share price can go down, and we'll look at this based on technical analysis, right? So we can do it. Now, in general, we can see that based on this calculation, it gets 43 points based on TACN guide. It's again the highest point. Okay, so it gives us certain security that we get. Now, earnings would be only 8th of August 2017, so we have nearly 2.5 months to do something about it, so we can enter this position without any risk that earnings could be something tricky. But again, if we look back at Value Line and the earnings predictability, I won't be afraid of these earnings because the company has 100% of prediction right, kind of, in this particular case, which is pretty good for us. Okay, but it can change at any time, so we have to take it into consideration too. Okay, do you have any questions on that, please? If everything is clear, put pluses. Okay.